Welcome to the Crypto Compliance Podcast by Gatenuts.
Pawel Kuskowski, welcome in Crypto Compliance by Gatenuts, where compliance experts and practitioners are talking about current market events and general compliance aspects. We do this to promote compliance in crypto, bring interesting topics and top-level practitioners. I would like to ask you to subscribe to our channel, to YouTube channel, to Spotify channel, comment it and share it. All of your support is necessary for us. Today, I'm here with Henry Balani. Henry is an executive and academic with the board-level experience in maturing high-growth regulatory technology firms towards successful exits. He currently leads Encompass industry and regulatory affairs strategy to identify trends and influence policy in financial crime compliance, specifically in anti-money laundering, counter-terrorist financing, and customer due diligence. He has consulted with international government agencies, including the IMF and the World Bank, and provided guidance on emerging money laundering channels, including trade finance, cryptocurrency, real estate, and high-value assets. He is an academic. He lectures on international management and financial crime compliance and publishes research related to impact of AML penalties and regulation on banking sector valuation in the US and Europe. Today, during the session, we had very in-depth conversation on the size of money laundering in the world. What does it mean? How we calculate this. The long-term application of the regulations is actually benefiting the industry, and whether the cryptocurrency segment should actually seek more regulations and better regulations applicable to them. So please welcome Henry Balani. Thank you. Hi, Henry. Great to have you here. Great to see you. Henry, we meet on this Crypto Compliance podcast. Tell everyone your background and your, incredible story with, financial sector in general and compliance in general.
Yeah. Pawel, thanks for having me. First of all, I want to start by saying appreciate the invite, appreciate the ability to kind of speak to you about some of these interesting topics. It's rapidly evolving, obviously, the area that we're in. So it's also interesting to kind of get a pulse check as to what's going on. Let me give you a little bit of background about myself. But first of all, just want to make sure that any views that I am expressing really are my own personal views and not necessarily representative of my organization. So just want to make that clear from the get-go.
Yeah, and it's interesting because, this is the interesting, typically we have this, I only have this from compliance people, and considering that I invite a lot of compliance people, I have these statements and, this point of view, I hear this a lot.
So I live in the compliance world, certainly, but I live in the compliance world more from a regulatory technology perspective. And just kind of give you some context. The firm that I'm currently working with, it's called Encompass, where we actually service the large banks, global banks, in terms of their know your customer onboarding process. I presume this audience is fairly familiar with what that means. But essentially, the idea here is to ensure that when a bank is bringing on a new corporate customer, say a large corporate customer, any large company like a Shell or a BP or a Rio Tinto or whatever other companies out there, they need to make sure they identify what that corporate structure looks like with the intent of identifying the beneficial owner. And the beneficial owner is basically the majority shareholder or the person that's got control over direction of the company. And why do they need to do that? Because ultimately they need to determine if there's a risk of that particular individual. And it comes down to individuals at the end of the day, that whether they are potentially a high-risk individual, are they a bad guy, so to speak, using simple terms, in that they may be a sanctioned entity or that they may be a high-risk politically exposed person, or some kind of negative news associated with that individual. And so it helps the bank actually determine the risk as to whether they want to onboard. If they're, for example, dealing with an entity that's based in a sanctioned country like Iran or South Sudan, or nowadays, lots of individuals coming from Russia. It becomes a real challenge for these banks and becomes a liability in terms of regulatory compliance for failing to identify that. And so it becomes a real challenge from that perspective. And so the company that I work with, Encompass, provides the technology for being able to do some of the onboarding, and specifically focused on banks versus, I know, for example, Gatenox works on the crypto side and the Web 3.0 side. It's a little bit different, but otherwise the objective is the same. Market might be different. That's kind of where I'm currently at. I'm focused on some of the regulatory side of the issues in terms of what's happening currently. For example, in the EU, where we got this whole debate between privacy versus transparency. And the issue then becomes, what does that mean from crafting money laundering regulations? So I spend a lot of time in that. I'm also a part-time academic. I find I need to find ways of keeping myself busy. So what I've done, a couple of years ago was actually did my doctoral research into the impact of money laundering regulations and an impact of penalties on banks. And banks in the sense of valuations. So I'm a finance compliance kind of guy. And so it's really a question of what happens when you've got the rollout of regulations, when you've got the rollout of penalties and so on. What does it mean to the banking industry in general? So I spent a lot of years in that. So it's something that I'm very familiar with. And, I'm sure we'll talk about that a little bit later on during this podcast, but it's just interesting to give you some context. I'm a technology geek. I love technology. I'm fascinated by what's happening currently with AI. Got on the crypto bandwagon fairly early and really kind of ridden it since. Enjoyed what the blockchain has to offer from a KYC, know your customer perspective. So it's really about how to use technology to help solve this challenge that we have, which is really trying to solve financial crime.
And you mentioned definitely two interesting topics. One is the privacy, and second is actually, how we are applying this into the crypto ecosystem, right? And also, your academic viewpoint, and you publish very interesting papers, which were talking about regulations actually improving economical standing of the sector, right? And I've written too, assessing the introduction of AML regulations on back stock valuation and empirical analysis, the impact of fourth AMLD on the valuation of EU banks. Right. That's something which is definitely, and I think this is something that needs to be heard properly in our crypto space, because when you talk with some sectors, especially DeFi, right? And I put some video recently on DeFi saying that, we don't have to be regulated, we don't have to apply AML rules, and that's something that I strongly disagree for a number of reasons. One is the financial crime, but what you're saying also is, and that's something that is new and refreshing, is that actually anti-money laundering rules properly applied can increase the value of the sector, right?
Exactly. Yeah, no, it was interesting because, when I started this research, quite a few years ago, and, I thought, well, does it really make sense? Because intuitively, right, you can argue that regulations are good for banks. You can also argue intuitively that regulations are bad for banks, right? Yeah. Because the argument that, we'll get into the reasons why, but kind of that's the hypothesis I started with. What does it really mean when you look at regulations? Because again, remember, I come from a regulatory compliance background. I also come from a banking finance background. And so kind of putting the two together. We all know that, it's interesting to look at the idea that we want to fight financial crime. That's inherently obvious. That's a good thing to do. But at the end of the day, you follow the money. What does that really mean, right? In terms of how does it impact a bank? Because what's also interesting to note is that when you look at all of these fines that banks have had over in the past, penalties and so on, look at the 2008 global financial crisis and so on, very few individuals have actually been thrown into jail. Right? Very few individuals. And there've been some.
On this point, Henry, I just find out, there's article in Financial Times since 2008, there was 55 billion in fines applied on the banking and financial sector related to any breaches of regulation, primarily the AML. It's incredible, right?
No, it's incredible. To me, it's incredibly low in terms of the penalties, right?
But because it's almost like the other part of this almost sentence is so how much money is actually laundered, right? This is
absolutely
the amount I think is staggering.
Yeah, no, we can get into a whole discussion about the amount of money laundered through banks, through the global financial system, et cetera, et cetera. I mean, there's studies out there, and as an academic, it's still very immature in terms of how we evaluate that. So, in fact, one of my pet projects is actually thinking about how do we actually value financial crime through, in terms of the global financial system. Very, very difficult to do. But again, perhaps a separate topic, a separate discussion. But what I wanted to kind of focus on really was trying to understand the idea that, look, we know that, money laundering is happening. We know that banks continue to receive penalties and so on, yet we still continue to see these things occurring, right? And so what does that mean? And so go back to the idea of follow the money. And so my research focused on, well, what does it mean for the bank's stock price itself, as opposed to, people getting thrown in jail and so on? Because I would suspect that if you threw senior executives in jail, you'd see a difference in terms of the culture of the organization, right? But if you look at the actual penalties themselves, even the largest penalty to date, right? This goes back to probably 7-8 years ago. There was a large French bank. I won't name names, but it starts with B.
I'm BNP Paribas. I can name it.
They were fined $9.8 billion. Right? And that's a significant amount, right, for you and I. But for the bank, it's really not that huge of a deal in terms of their P&L, the bottom line, right? It's probably 0.003% of their P&L at that point in time. But the problem is this, right? Even the largest banks, you intuitively still see what's happening in the industry in terms of these penalties and so on. And so my question really is, does it really make a difference? And that's what kind of my research set out to do. And what I found at the end of the day, actually, when you look at penalties and when you look at the introduction of regulations, the value of the bank stocks actually went up. Oh, that's interesting, because you would intuitively expect it to go down. And you can, there's many arguments you can make. I took probably about 30,000 data points over a period of 10 years and did the analysis as terms of when in this case, that particular article you mentioned is really about the fourth anti-money laundering directive, and tried to understand what that meant, right, in terms of the introduction of the regulations themselves. But at a high level, in terms of the findings, was as a result of that regulations, the value of their stock price went up. Okay, and you sit back and say, wait a minute, that's interesting, and I can rationalize it this way, right? Because of regulations, there's now greater transparency in terms of what banks have to do, how they detect these types of potential money laundering activities, the process by which they're supposed to report those issues, and the clarity that shareholders and investors get in terms of their reporting procedures. That's all good, by the way. Having this regulatory process is good,
but
that's why
you could argue that this would be done anyway. That's first point. And second, in what way it actually benefits? Is it because we know more about the customer and we have explanation on why we collect data from you, or what's
so let's break that down, right? I mean, your first point is that they would do it anyway. I would argue that if there was no regulation, they wouldn't do it. All right. Okay. Or at least they'll put very minimal effort in terms of being able to actually go through that process. With regulations, what it does, it provides that certainty and that clarity and the process by which they go through, and it's standardized across all the different banks. That's where the value regulation starts to come in, right? If Bank A does it this way, Bank B does it this way, and so forth. There's something called suspicious activity reporting, for example, SARS, right? And like, for example, in the US, there's a certain process, there's a certain form, there are certain trigger points that are actually used in terms of reporting those reports. And the fact that it's consistent provides the predictability Because as investors in any industry, we want predictability. We want the ability to actually identify potential risk as and when there is. Regulations provide that. So I think in terms of the argument that they would do that, I disagree. I'd say that they're only doing it because of the idea of regulations, and therefore you get a positive impact from that standpoint. I get more comfort. I mean, as an investor, I'm risk averse. Typically in any activity that I do, financial investment activity that I do, so that regulation provides that clarity. And
so the argument here is that because the banks would have this scrutiny, the risk of doing something wrong is smaller than without the regs implemented, and in this way, we actually see more money coming into the stocks of the banks. Okay, that's very interesting, actually. And that's something that, we can play back definitely to the crypto world, right?
Yeah.
This is almost like, and it's something that, the argument that I am trying to convey for some time to, especially to DeFi, because, majority of the centralized exchanges would be already there, but DeFi is like simply saying, listen, we don't want to do this AML, right?
Yeah, no, I mean the thing is, regulations are good. I mean, obviously DeFi and the crypto industry regulations are relatively new, and I understand that, recognize that innovation is always something that continues to happen in the financial services industry. But you go back to the initial Great Depression back in the early 1920s in the U.S., right? As a result of the Great Depression, we had new regulations that were introduced. Glass-Steagall Act, for example, one of those, right? I mean, there's when you go back to 2008, you go back to the Enron crisis, right? There was various regulations out there that also were actually introduced as a result of that, and that becomes something that's actually, again, good for the industry. I mean, as I said, the Glass-Steagall Act after the 1929 stock market crash really made a difference. Sarbanes-Oxley in 2002 really made a difference in terms of identifying, potential fraud. I mean, obviously, Sarbanes-Oxley was a direct result of Enron and the poor reporting that they had. So I can provide many instances where you actually see, regulations coming in. In some ways, it comes in after the fact, unfortunately. As knee-jerk reaction to whatever the crisis was. And, what I'm suggesting is that actually you place thoughtful regulations ahead of schedule, you're going to see a lot more improvement in terms of those industries. Now, look, if you are a firm that's looking to succeed, I mean, most firms are set up to succeed in the market, to provide some value to the market. You want clarity, not in terms of process. You as an investor or as a customer of that particular institution want to make sure that your money is safe. You feel protected. And that's where these regulations start to come in. So, I don't buy the argument that DeFi says we don't need regulation, or that's not going to help us, or we can do it our own way. We're suspicious, et cetera, et cetera. I don't buy all of that.
No, I definitely agree. And but at the same time, they say, we want regulations, but very, very light version. So we would have this kind of, rub stamp from the regulator, but we can do the way we do, and we don't have to do all the, crazy stuff related to customer identification. And frankly, I tell you that, other argument. During my time in CoinFirm, where we did blockchain analytics, we issued in 2018, I believe, first what we call the report on the exchanges, right? Know Your Exchange report. And one of the let's say thing that we checked is how many of the exchanges would have proper, and we also rank this, between like really proper, which we do KYC, incoming, outgoing transactions, regardless of the size, into zero KYC and anything between. Like 2 Bitcoins you can withdraw without KYC daily, and we completely fine, right? So those in between, and we check this, and there was clear picture at that point of time that when you had KYC, your volume were much, much slower, actually, very close to not surviving. Funny, all of those, who at that point of time didn't do proper KYC, right now they are really doing this in the proper way, right? Or close to proper, or at least, what we see as proper, right? Or what we see from them, right?
Yeah.
So there's maybe it's different stages of almost creating an ecosystem, which is, then it's very difficult to get in, right? And this is where the regs are actually helping to grow the companies which are already there. So it's really interesting.
Yeah, no, I hear you. I mean, but I think, in some ways we shouldn't be shooting the messenger, so to speak. And here's what I mean by that, right? KYC itself is a process that needs to happen, right? When a bank or when a financial institution, when any money institution brings on a new customer, they need to know who you are. I mean, that's just the reality of it, right? We also need to recognize that the world that we live in today, I mean, this may not be a popular opinion in Europe and other countries outside the US, but the US dollar reigns supreme, especially in financial transactions, global financial transactions.
Everyone knows this, so there's no question around this.
And so the challenge becomes you have to play by US rules.
Yeah.
And we recognize that the US dollar is also being, used for political purposes, weaponization of the dollar, weaponization of trade. Again, a whole separate discussion around that. But the reality is that you got to play by US rules. And part of the US rules requires you to make sure you know who your customer is when you're working. When you bring them on board. That's just reality of it. The problem I think that we have in today is that the way we do onboarding, the way we recognize a customer, is a cumbersome, slow, complex process.
Yeah.
That's the issue. It's not the issue that you shouldn't be doing onboarding, understanding who your customer is. It's how you go about doing it. That's, I think, where the inherent challenge is. And that's where, technology innovators and so forth come in and try to improve that whole process, make it easier, make it seamless. Yes, there's certainly a cost. And if you're looking at, onboarding smaller customers in fast-growing, crypto exchanges and so forth, as you highlight, the cost can be quite burdensome. But that's something that, in some ways, it's a failure of the industry, the fintech industry, to be able to make easier and ensure that we should never get rid of it. Just because it's difficult to do doesn't mean that we shouldn't be doing it. That's, I think, the point here. Yeah,
I completely agree. And, I had very interesting conversation yesterday with one of the protocol. And, they have really robust KYC team, knowledgeable, compliance team in general. And, what we are building, and this is what we discussed, at the beginning, is that, you guys, Encompass is building this, very similar solution for banking, sector and more traditional finance. What we are building is more, it's catered actually to crypto sector, right? With all the differences and, nuances, on the way, connectivity, all this different stuff. And I asked this question, how do you use right now, when you onboard any partners, vendors, whoever? We said this company, first, it's not the best company on the market, right?
Okay.
Which is also, I think, reflection on what is actually, how the teams are perceiving something, in terms of quality, right? And the second thing is, it's very, very, very traditional in the approach. And I said, listen, we are building, completely new stuff for our sector, which is solving the problem, can be repeated, can be, used again, all this stuff, which is playing very well to Web 3.0. And what you're doing, you're actually promoting, because you are signing the contracts with the guys who are doing, very traditional stuff, and they do this wrong. So that's really, what you said is great point. Why is actually this failure happening? Why, we see these problems and we don't solve these problems, right?
Yeah.
And we know, in terms of corporate onboarding, I think individual onboarding right now is, more or less correct, right? More or less, we are getting into the stage where we can say it's all right. But corporate is just disaster.
And no, I absolutely agree with you. And it inherently goes back to some of the challenges that we have, right? Because when you look at corporate onboarding, so let's assume that individual onboarding is a little bit easier than corporate onboarding, which is generally correct. I would agree with that, right? Corporate onboarding, you start getting to the wide world of shell companies. And you start getting into those types of challenges where the purpose of a company is set up not to trade, but to act as a cover for other types of transactions, typically illicit transactions, right? Because the reality is that when you look at these companies that have been set up all over the world in different tax havens, offshore, whatever you want to call them, right? For now, it's being designed to cover a certain set of transactions, whether legitimate or illegitimate, right? If it's not transparent, my first reaction in dealing with those types of companies is, well, why are you hiding all this stuff? Where's why aren't you being transparent about what you're doing? And the arguments traditionally have been, well, it's sometimes designed to protect the owners of the assets. One classic example was you go back to Walt Disney, right? Walt Disney, when it initially set up their location in Orlando, they needed to hide the fact that they were actually buying land in the Orlando area because that's Walt Disney World, right? Because the minute people heard, that Walt Disney's interested in buying that, real estate prices would have shot right up, right? Because they know, obviously back then Walt Disney was. That's just one example, okay? They were trying to hide their identity because they didn't want to impact the value of the market over there. But there's also many other examples where actually it's they're hiding their identity because it's illicit. Because the transactions that the source of funds that are coming from are either corrupt or that there's exploitation, or it's criminal activity, drug criminal activity and so forth. And that's where you get the challenge. And so you've got an industry out there now which is really designed to be able to create all of these corporations, these nested corporations, these shell companies, different terms around there. They make it really, really, really difficult to find who the beneficial owner is. That's where you point out it's complex, it's difficult. So absolutely, we deal with that all the time. We have banks coming and say, please help us because we have to comply with regulations. We've got this current, war in the Ukraine. You got lots of Russian entities, corporations, etc., being sanctioned, and the volume is incredible in terms of the number of entities that have been sanctioned as a result, just between last year and this year. Right, so it becomes really, really complicated. So it becomes really difficult. So I agree with you. Corporate onboarding is really challenging because of, number one, the reason why these corporations are set up in the first place. They're designed to hide the true identity, and number two, the sheer volume of these sanctions out there that banks are saying I can't deal with this. It's really difficult. Today we all agreed that yes, we got to sanction Russia. We've got to do all these different activities and so on. The banks are saying, sure, I understand that. I agree with that. I don't have the ability to be able to actually accurately identify that. So this year going forward, I predict with you, right, that you're going to start to see a lot of regulators go after the banks saying you didn't do your job properly, because you haven't been able to identify who these sanctioned entities are. It's easy to just say, all right, here's a list of all these corporations that you need to go and find out. But with the idea of these shell companies, with the idea of these complexities and so on, it becomes even more challenging. So I think you're going to see part of that. So it becomes a bit of a challenge between onboarding for individuals, as you say. Typically, it's easier to identify an individual, but the volume, obviously, the value is lower when you look at large corporations that you're onboarding.
Do you have any data from your research which would be indicated what is the size of money laundering through shell companies? All right. So what's your estimate?
Yeah, I mean that's a $64 million question, right? Yeah. And no, it's not $64 million. But the point being that it's difficult to estimate, right? When you look at some of the traditional numbers out there, the most quoted estimates between 2 to 5% of global GDP. This is by the UNODC. And this was based on an academic study, by the way. I know this is little known. And by the way, it's about $2 to $3 trillion. That's what they've estimated in terms of the amount of money laundering estimates. But that's based on studies that were actually done originally in Australia. This goes back about 15 years ago, give or take. And this was actually based on the amount of drug trafficking. The problem is this: you cannot measure the amount of dirty money directly by definition. Because the problem is that dirty money is hiding. So I can't sit there and just start counting. Well, this is what it is, so on.
I tell you my take on, and this is one of the data points which I typically use in my kind of thinking of about like the size, right?
Yeah.
So in Europe, typically, what you can predict is the amount of VAT you should receive on the basis of products and services sold, right? So you have the underlying basis, and then you have the VAT. Typically in Europe, and I see this across Europe, very, very similar numbers, around 3 to 5% of the budget which should come from VAT is missing on an annual basis.
Yeah,
right.
Sure.
That's simple kind of indication, right? It's not total, GDP, but still, very significant portion and very significant, chunk, which is just, and we're talking about, I think, UK is 100 billion on annual basis. The VAT which is supposed to come and it's not coming. It's crazy amounts.
Yeah, and you highlight the challenges, right? Because what we need to do is we cannot measure it directly. You got to use proxies. So VAT, is one proxy. Go back to that original study that was done in Australia. It's based on drug trafficking, drug proceeds. So they identify that, right? So there's tax evasion. So you've got all these different proxies that you typically would use in terms of that. It's also the question of, like I said, they often quote one is, 2 to 5% of global GDP, about $3 to $5 trillion, somewhere around there, global GDP that's quoted out there. The challenge, I think, it's much more, quite honestly. I mean, it's much more because I think going back to your market, your example in Europe, right? What you're doing is you're accounting for VAT for the non-white market, not the gray market or the black market, right? So that, again, is a certain percentage, right? Different countries have different sizes of the gray market, black market. And so you got to add that on as well. So there are many more factors that you need to be adding on in terms of what potentially, the area is. The other part of it is, what do you mean by financial crime, right? What do you mean by, what is dirty money? When you look at tax evasion, for example, tax evasion was recently, I think probably only in the early 90s, I believe, was then considered, a predicate offense for money laundering. In other words, it's something that's just, been recognized.
No, it's actually, I think later, in Europe, it was, I think in the third or fourth money laundering directive, which just, said, tax evasion is a crime because one of the explanation of and it was interestingly Swiss explanation, right? If you didn't pay your taxes, which you're supposed to do abroad, that we fine, like from our perspective, it's not a problem,
Yeah, absolutely.
Didn't pay the taxes in Switzerland. Well, that's a problem, So I think, it was third. I think that's third directive in Europe, especially was.
Yeah, so it's interesting, right? So it's like, if you start including tax evasion, those types of, the number pops up even more, right? That 3 to 5% that we talked about does not include tax evasion, by the way. I mean, it's important to recognize that.
And that's very similar in crypto. I think.
Exactly. So I think that's really
crypto and tax evasion. I think we are talking about 50%.
So that becomes very difficult. So I mean, your question really, what was the estimate? I have no clue. I mean, we all don't know, but all we can do is identify what the proxies are, right, and then start to kind of estimate from there, and then go from there. But we do know that this is a problem, right? We do know this is an issue. We need larger organizations, like global organizations like FATF, right, Financial Action Task Force, the UN, etc., to actually go in and actually say, look, this is a serious problem, and we need to identify where this source of money laundering is coming from, and try and do something about it. And that's, I think, where the regulations start to step in as well.
Henry, I ask you a very uncomfortable question, right?
Sure.
And which I have in my mind for many, many years, right? Money laundering is very much connected with corruption, right? When we're talking about, all the government body which you mentioned, they are politically connected.
Right.
Do you think, there is a chance of actually them ensuring that it's almost like, when you look at this, it's almost like, by design, it's not being chased properly, right? And we know all these numbers, what's the amount of recover funds in the UK? 20 million a year?
Yep.
30, maybe 40. And we know for the fact that it's at least, 100 billion in the UK, right? So is there, do you think, it's a lengthy question, but do you think there is hope in the world to that the regulators and banks and all this, all different parts in this setup are committed fully to fight financial crime?
Yeah, I mean, I've been thinking about that too quite a lot as well. So probably, you and I have been the same page from that standpoint. It's a systemic issue. I think what you're pointing that out, right? A systemic issue inherent in all organizations. I'll give you one example, right? So, when we're looking at the, I think it was the third or fourth money laundering directive, when I was looking at some of advocacy efforts in the EU, we were looking at the risk of politically exposed persons, because that's one area where there's potentially high level of corruption, right? And we were actually talking to some MEPs, members of European Parliament, and it was interesting that the MEPs that we were talking to were actually on a list of PEPs. So here we are advocating for the transparency of these PEPs and saying that, we got to make it more open. This is how we should define it. This is how we should be sharing it, et cetera, and so forth. And that particular MEP was on the list. How awkward is that, right, in terms of conversation? And so you get those types of challenges and issues, right, because you've got that systemic issue going back again in terms of the people that are actually, the individuals that are actually in charge of formulating the regulations are themselves, more susceptible to, corrupt type activities and so on. So that's already inherently a real challenge. The second issue is this, right? We consider money laundering as a victimless crime. Okay, it's what that really means at the end of the day is, there's corruption, there's and there's money laundering, so on. It's not really affecting me personally necessarily, because I'm not being robbed of my money. It's not like somebody physically coming in and taking my money and so on. That was a mindset, right? Of course, we disagree. Of course, we know that it's not a victimless crime. There's lots of different areas like child trafficking, human trafficking, drug trafficking, and the list goes on, where it's not a victimless crime. People are actually being impacted and affected. So I think it's a realization that, look, we got to do something about it. I think that's where you start to see some of these types of changes. The Pandora Papers, the Panama Papers, all these different leaks and so forth, have really kind of brought to bear and, said, this is something that, we, in the citizenry, so to speak, need to be able to do something about it. So we got groups like Transparency International, it's again, many Tax Justice Network, many civil society organizations, many NGOs out there that are trying to advocate for change and trying to make the public aware that this is a problem. So yes, there is challenges in terms of the realization that money laundering, corruption is there. The problem is that we all inherently greedy, unfortunately. All right. So I think it was Nietzsche, somebody who said something similar like that, where the reality is that as human beings, we never learn from history. And the fact that we know that these things keep happening, and if there's an opportunity to be corrupt, as an opportunity to be greedy, it will happen. Right. So we haven't quite evolved to a human stage that, we can make a difference. But I think we can only kind of chip away at the edges. I've been doing this basically my entire career now, and kind of continuing to be optimistic, chipping away at the edges, trying to at least make a slight difference. I think that's better than saying, forget it, we're not going to do anything about it. So will corruption continue? Absolutely. Absolutely. No question about it. But does it mean that we should stop, trying to fight financial crime, fight corruption? Absolutely not. We need to be able to continue to chip away at doing some of these types of things.
And I think, what you said is very valid. And I always try to connect, all the like human trafficking. Human trafficking, it's one of the human exploitation, human trafficking. Drug trafficking is like, it's more difficult to kind of get to really personal at the personal level.
Yeah, sure.
But I think the issue with AML is money laundering in general, is that it's so complex. That typical person would have difficulties to connect, right? Why money laundering, avoiding tax, how it's impacting. And I remember, I was training. I'm not gonna mention. Oh, I can mention HSBC, right? I was training HSBC team in Moscow, right? And the team over there, even there, these guys were excellent people, like smart, all this stuff. And they couldn't understand why corruption is bad. Right? Like we said, it's like it's like an engine, right? You just it's make it work, right? It's like fluid, which travels, and like that. No, it's actually, there's so many negative consequences. I think really corruption it's eating out the society as at the moment. I think that's
absolutely. I teach a course on money laundering and new technologies
right
in the US, and we talk about corruption. We talk about what corruption actually means, right? I mean, corruption is also facilitated payments is also considered a form of corruption, right? It's like when you look at the UK regulations in terms of their anti-corruption, anti-bribery and corruption regulations, you look at the US, it's different, right? In the US, we allow something called facilitation payments, which essentially the idea is that you're taking a particular service and you speed that up by providing them more money. Right. So it's like, if I need my passport.
So is this allowed actually?
This is allowed. Yes. In the US, you're allowed to do that. But essentially, I mean, if you want to get your passport in 2 days versus 2 weeks, you give more money. Right. That's facilitated payments.
You give money not to individual who is in charge of issuing this. It's like institution, right?
It's an institution, exactly. So it's
institutionalized corruption.
Absolutely. Exactly. And so you've got those types of values. So if you have some things, definitional issues here, even in the Western world where we kind of more or less align on what corruption is in terms of whether it's good and bad. I mean, what kind of hope do we have for countries where the values are different? China, Middle East, etc., where this is normal to provide some level of gifts or some amount of that. I mean, I teach a course in international business, and we talk about corruption, and we talk about how a U.S. company needs to work in China or in the Middle East or wherever, and where they expect a certain level of transactions, right? Initially, even before the deal is signed. And that's just normal. So how do you deal with that? It's interesting. In a prior company I worked with, again, a large international public company, in fact, we worked with, we told our employees that if you get stopped by, let's say you're in the middle of a country where you get stopped by the police and a roadblock or something, and they ask for a bribe to allow you through, give them the bribe, give them money, because then it's physically, you may be hurt, but ask for a receipt. Okay. And so and sometimes they will give you, sometimes literally, we have one of our consultants, who got pulled over. He asked for a receipt, they gave it to them, and then he moved on, and he claimed the expense in his part of his regular expense reimbursement process. So it's recognizing that even the definition of corruption is different across the world, because again, is it victimless, or as you say, is it personal? Is there a human face to it? I think that's part of the challenge as well.
Yeah. What's your view on the number of companies in the world? Right. I mean, there's a couple of different numbers which are floating around. So number of companies between like 300 million to 500 million in the world. What's the what's your view on this? What's the real number? Because I mean,
interesting question. Where are you going with that? That's an interesting.
Yeah, I think I had this when I see this type of number, right? This is almost like what 1 in 16, one entity per 16 people in the world.
Okay.
Right. That's a little bit too many, right? To make it valid.
Yeah.
That's what's the reason? And
yeah, it's interesting. I don't know. That's an interesting question. I don't know the number, but I can tell you, for example, let's take a more specific, concrete example of that. Delaware in the U.S., a state that's well known for incorporating companies. And so what's interesting is that in Delaware, I can't think of the population, but it's in the hundreds of thousands in terms of the population itself. And in terms of number of corporations registered, is 1.6 million. All right.
Wow.
So that many more corporations. I think we need to validate that somehow in terms of the number of
1.6 million.
Yes, in terms of corporations incorporated in Delaware. Versus the employee versus people living in that state. So it's like, obviously, it goes back to your point, right? Why that makes no sense. I mean, you go down, like, for example, in Miami, right? And you go to maybe South Dakota, Wyoming, these at least states in the U.S. The number of corporations registered far exceeds the populations of those states. That makes no sense, right? And so it's a reflection of the purpose of corporations. So I think, going back to your example, I mean, the number of global corporations. I don't know what number it is. I don't know whether we
I think
really
I remember this that. Is I need to check this, but I believe that it's from Dow Jones.
Okay.
That's the number. That's one, and there's Statista, which is quite good source of data. Is they are talking about 330 million entities.
Okay.
But so even if we get this wrong, it's like around, I mean, what you said, if we have 1.6 in a small state in the US, right? I mean, obviously known very, very, very much, for setting up a company in Delaware. If you have 1.6 million, it's possible, actually.
Yeah, no, absolutely. And so the point being that there's many more corporations that are set up, and there are many more corporations that are individuals, right? I think that's kind of what we're saying here, right? And the question is why? Why do we even need that?
Henry, where we are going with KYB, the corporate analysis in terms of law. Do you think it's tightening up, or we have the debate which is going to be dragging on? And I know that Europe is different, but we had just the big backlash because of the UBO discussion. Mm-hmm. And it would be great to hear. I think we have the same point of view, but it would be great to hear from you.
Yeah.
And then we have the US aspect, where, frankly, I think the discussion is very, very tense between this disclosing or making this as obligation, disclosing UBO, all this stuff. So where do you think in the world we are?
Yeah, it's interesting. I summarize it by the title, the banner for the Washington Post newspaper: "Democracy dies in darkness."
All right.
I love that. I love that quote, right? And it's in some ways, the idea of transparency is really, really important to be able to share that. So we need to continue to push towards openness of information in corporate registers, right? Again, the argument can be that you need to protect certain individuals and so forth. But the idea of a company, a shell company, that's being used for other than trading makes no sense. It makes absolutely no sense. And so I think you're getting that understanding in the public that this is something that we need to change. The Pandora Papers, all the different scandals and leaks that we've had so forth, has brought that to the general public. And so I think it's good news. I think the momentum is there. That yes, we need to be able to create more transparency about KYB, about know your businesses, know your corporates, and so on. And now I think the next step is to make it accessible, make it easier. Going back to our conversation earlier in terms of the idea of corporations that are structured, that are nested, that are opaque, and so forth, they make it much more difficult. We need to be continuing to get rid of that. Yes, you have regulations in the US, which is actually, yes, there's challenges, but the mere fact that in the US, You got the Financial Crime Enforcement Network, FinCEN, actually advocating for the creation of a federal level register is really, really positive. I think that's really great. Yes, there's going to be bumps along the road and lots of pushback and so forth, a lot of tension, as you mentioned, but that's the way we create legislation here. That's how sausages are made in the US, really kind of going back and forth. But I think the trend is in the right direction. I think we now recognize that, identifying beneficial ownership is important. Again, I've been in this field for a long time. Only in the past few years have we talked about UBOs, and people actually now saying, okay, I know what a beneficial owner actually is. And that's really fascinating. That's a great step forward.
True. But, so at the same time, what's your view on the state of regulation? Because I think, frankly, AML rules in Europe, I mean, I don't think it's that much in the US. Yeah. Regulations are right. I think, regulations are pretty decently written, understood, clear. Mm-hmm. The funny part is that every industry, traditional, crypto, art, lawyers tend to disregard or misunderstand them completely. Because just to give you an example, when I was in the banking world, we had many times this conversation. What we're gonna do if there is we're gonna end up with, I don't know, Cayman or BVI entity somewhere in the chain of corporate structure, right? And reading the rules, you should say, thank you, we're not gonna be banking with you, right? That's it. It's written 100%. Sure. And the practice on the market is, well, if you cannot find this, take 2 directors, right? Yeah. And I was like, Jesus, it's not written anywhere, right? Yeah. And I heard this from the regulators. Heard this from the regulators, and I said, like, you have the rule, which says, like, you need to identify UBO. Yeah. If you are not able to identify, you do not have business relationship with this client. Full stop.
Well, I hear you. I mean, it's interesting, right? You talk about the US versus the EU, right? The EU makes lots of regulations, but enforcement is poor. The US makes lots of enforcement, but regulations are poor. So it's the other way around, right? So take your pick, because the point is that it's a roll of the dice, right? You got relationship managers in these banks that say, I recognize that this is higher risk, but you know what? I may be able to make more profits out of that. So therefore, I'll go ahead and take the risk. And it goes back to the systemic issue. There isn't much enforcement, so I'll take my chances, and that's fine. And by the way, it won't go to jail anyway. The company will pay a fine. Maybe maybe we'll let go or whatever. But that's it. I'm not going to get thrown in jail. So what's the difference? I think that's really
in Europe. It happens. In Europe, sometimes it happens, but you go to jail because of broken rules. The execs. I mean, typically what it happens is someone responsible for the compliance. So UK, some people from compliance AML went to jail, and there was really, But
the proportion, and it's disproportionate in terms of the effectiveness of it, right? Yeah, sure. Some 1 or 2 people go to jail. How much more millions and billions have been laundered as a result? So that's part of the thing about the challenges.
Henry, this was excellent. I really like it. And I think, we need to do a follow-up on we didn't talk about this, but I definitely need to pick your brain on, different jurisdictions. And actually, are we able to create any regulatory environment, considering you have offshore jurisdictions, all this stuff, where you can set up your business and you don't have to care about this, and it's still a valid business, right? Yeah. So we need to do another episode on this.
Absolutely. Happy to, Pawel. Yeah. Appreciate very much for the time. Thank you for allowing me to speak. And, we'll look forward to talking again.
Sounds good. Thank you.
Crypto Compliance, brought to you by Gate Knox.